Let's get started. So for much of the past 30 years leading up to the pandemic, there have been four big forces that have driven the global economy and more positive tailwinds. They were globalization, which brought literally billions out of poverty, innovation or technological advances, a relatively stable geopolitical environment, which allowed trade to flow more freely, and very positive demographics, which are starting to reverse. All of these made aggregate demand much more responsive, aggregate supply much more responsive to demand. But things have changed considerably since the pandemic and the war in Ukraine. Everything's changed. And we wrote that in our April outlook. Today, after a period of trying to stimulate the global economy and stimulate demand, policymakers are now trying to take a more balanced approach to shifting demand and shifting supply and demand dynamics, as three of the four forces are now undergoing a significant adjustment. The first is the pandemic-related supply chain problems in the US-China trade war really have caused a rethink of globalization in its current form. And while at the same time, the invasion of Ukraine, the problems in the South China Sea, ongoing concerns about terrorist threats and bad actors around the world have actually destabilized the geopolitical environment. And at the same time, we've started to move from 1980 to 2010. That period was a very positive one for the demographics and working force populations, but in the last 10 years, it started to shift more negatively. So we have worsening demographics as well. So basically the only leg of the stool that's still working is innovation, which continues to raise growth and lower inflation pressures. But we're in a very awkward time right now for the global economy as we're going through these major shifts and regime changes, basically, of how the economy works and how things operate. So today I want to touch on the topics coming out of Jackson Hole, which are really about policy constraints. I'll spend most of my time discussing that. I want to share a survey from Gallup on the UK and what people were thinking there in the last couple of weeks, and I think it's going to be very different going forward. And then also give a view of the student debt debate that's going on, as we have $1.7 trillion of student loans outstanding, and the Biden administration is talking about forgiving some of that debt. And what are the implications of that? So that's what I want to cover today. So let's jump right into it. The title for the Jackson Hole Conference, which I mentioned last week, and Bill Deukler picked up on this, was Reassessing Constraints on the Economy and on Policy. And I think we're really at a period where we've reached the end of an era of zero or negative interest rates. That has clearly come to an end. And now it appears that we've wasted, as governments, a major opportunity over the last decade to make the structural investments that we needed to make. Instead, they focused on shorter-term fixes. And now we're stuck with a problem where we've done too little on the structural side, too much on the stimulus side, and we're dealing with the problems of that. And that's left us with an economy that's in a really vulnerable spot, which should lead towards a lot more variability that's going on. I think Schäuble at the ECB said it well last week. He said, this is a less favorable environment over the medium term, one in which shocks are potentially larger, more persistent, and more frequent. And the shocks he cited were climate change, which would increase volatility through natural disasters, excuse me, and supply chain disruptions, the slowing or fading of globalization, which has acted as a giant shock absorber on the global economy, given it's really solved some of the labor supply and productive capacity issues. That was a real positive. That's shifting. And the other was the end of elastic fossil fuel energy supply due to the war and the green transition. And Mark, the point Schäuble highlighted on the green energy transition was the one we talked about in London 2 years ago, where he said that in the near term, it'll create inflationary pressures, but over the long term, it should ease those pressures, but we're going to have a number of shocks as we get there. And I think that's really kind of the dilemma that these guys are facing, is they've shot a lot of bullets, and we'll take you through how they shot them and what it means for us. So This is a chart that I've shown in the past. It's the global monetary and fiscal stimulus to counter COVID-19, and was the money spent from February 20 to May of 2021. So it doesn't include some in the US, I think close to $1.5 billion or $2 trillion of initiatives. $1.5 trillion to $2 trillion of initiatives aren't counted in these numbers. But basically, from a monetary perspective, the Fed expanded their balance sheet to $9 trillion and are now in the process of starting to reverse that and take that down. The ECB is still putting its foot on the pedal. The Bank of Japan still is in an easing situation. The UK was tightening, and China is easing. But you've had a reversal from most of the world in central banks going to a tightening mode, with a handful easing like China is to try and manage stability. But if you look at the fiscal stimulus that's been put out, this is why there's not much room and there's limited capacity. They shot a lot of bullets and didn't get the bang for the buck that they were looking for. And I think that's a challenge that we're going to be faced with for several years as we come out of this. And it's going to really test the leadership of politicians, as well as the ability to hold the population together to go through the pain that's going to come out of this. And that was one of the key highlights of Powell's speech is there's going to be a lot of pain here. But around the world, we have massive structural issues that need to be addressed. We have too much debt in too many parts of the world. We have to fix decaying infrastructure, not only physical, but education and digital infrastructure. In the US, we have to correct a flawed immigration policy to help offset some of the demographic challenges we have. Around the world, they haven't done a great job of addressing inequality. The US, another problem is lowering healthcare costs, a long way to go there. And now, because of the war and the realignment of how geopolitics is playing out, everyone's focused on reorienting supply chains and strengthening national security, things that should have been done all along, and we're playing catch up there. So I think that's one of the issues that we're going to be faced with. And you're doing that against a slowing global economy, and I think that's part of the challenge. I've shown this chart, but we stimulated up to get to the 6% from very anemic levels due to the pandemic and the post great financial crisis period, to where we jumped up to 6%. And we're obviously going to come down this year, but it's the strain that's coming with the higher prices that are weighing on the system, that are redirecting capital to areas that are less productive spend and not as much going to the areas that we need it to, just so people can survive. And I think that's putting the policymakers in a very difficult spot, because they will continue to push to do a lot of short-term stuff just so they can get reelected in one hand, but also to deal with the immediate and ease the pain on the system. But there is some opportunities for growth, and this is a good chart to show how well the economy is done in a low-growth environment with a lot of stimulus to rebound from the financial crisis. But the problem is it's going to be uneven, and who the beneficiaries are going to be very unequal. There'll be some very narrow winners, both from a country perspective, from a company perspective, and from an individual perspective. And I think the haves and have-nots issue is going to continue to weigh on the political debate and make it harder to move forward. But the other issue is we are moving off a period of historically low inflation. A lot of that, as you see, came from those four global pillars that I talked about, and now they're starting to reverse and move up. And that's the strain that's going to be put on policymakers of a slowing growth, uneven beneficiaries, and rising inflation pressures, which are going to be hard to bring under control given some of the limitations that the central bankers have. So I think that's the challenge that we're faced with, and it's going to be a significant problem. And with central banks where they are, and with fiscal policy where it's been, it's going to be very difficult for a lot of countries to pull out of this. And to us, that is another reason why more capital will flow and continue to flow to the US economy with the strong dollar and with our energy setup that we're in. We think we're in a slightly better spot than for the US. But I want to switch gears and get to the UK. And today, Goldman Sachs, I think, projected that inflation could hit to 22%. Last week, it was Citi talking about 13, possibly 18. And now you have Goldman coming out at possible 20%, 22% inflation level. So living standards are declining. And this survey from Gallup was done in the recent weeks. But I think when we look at this, you've seen the big move up in things getting worse, almost doubling, things getting better down a third. That's not a great setup for an economy. When they asked, are their local economies, the city or area they live in, getting better or getting worse versus getting better? Again, a big directional change there. And obviously, the last one, making ends meet. Are they having trouble getting by? And people have managed pretty well over there for a difficult period with Brexit and other areas. But I would just point out the survey started probably in June. And I think the energy crisis that's coming the way, I believe if we saw these numbers in 3 more months, they'll look even worse than they are right now. And I think it's just a sign of what's going on in Europe as well as the UK, as we're struggling to deal with the fallout from the war and supply chain disruptions, and really the energy crisis that's hitting at a time that when you have low growth and more challenges, it's putting greater strain on the governments. And I think the number is that, what did I see? That the energy prices could lead to where 40% of the population moves to having trouble getting by on their regular income. So you could see some pretty dramatic changes coming, which is going to put more pressure on policymakers to do the near-term things and not enough time spent on dealing with the structural issues. And that's going to perpetuate the problem that we're in and make it harder for governments to really deal with the core roots of the problems and move their economies forward. So very difficult challenges and a lot of pain coming. And that was the real message from Powell on Friday, was there is going to have to be pain to be felt to bring inflation down to levels that will become sustainable. And one of the key messages harkens back to something that Paul Volcker said back as he was addressing the height of the great inflation in '79. He said, inflation feeds in part on itself. So part of the job of returning to more stable and more productive economy must be to break the grip of inflationary expectations. And I think that's what the Fed's going to try and do now. That's what all the central banks are going to try and do, but they're going to have to do it with less firepower because we're still at very low interest rates, and the global short rates are now just around a little over 3%. Makes it a very difficult setup when you need usually 4% decline to get there. And we're doing this at a time that central banks are putting a lot of tightening on the system. So more strain coming and more pain. But I think the key message is it's going to be very uneven beneficiaries of this and much more narrower beneficiaries from an investment perspective. So switching gears to the student debt forgiveness debate that's going on in the US. And basically we have 1.75 trillion of student debt. It's grown very rapidly over the last 2 decades. And it's really in a runaway situation. And last week, President Biden put a waiver on $10,000 of student debt for most people, and another $10,000 if they take a certain Pell Grant in the US. Surprisingly, the pushback came as vocally from 2 leading Democratic economists, both who've served in Democratic administrations, Summers and Jason Furman, very negative against this, and not about the concept as much about the timing and some of the practical nature of it. But basically what they were saying was, Summers believes it's inflationary. It's not solving the most important problems that we have in the country today. They don't believe that student debt is the biggest problem in his view. And it doesn't address the root cause of runaway inflation, which is interesting since he was the president of Harvard. And his other view is that he would rather people go through bankruptcy proceedings rather than forgiveness, so that they realize the challenges of taking on excessive debt. He thinks that helps address some of the moral hazard issue. Jason Furman was far more aggressive in his comments. As you can see from the quote here, he believes that this is a reckless policy. That was one of his kinder words for it. He also was very against that higher income graduate students are included in this. He doesn't think that was the best area of need. He thinks it should go more towards the people who were duped by some of the for-profit schools, people who didn't graduate and the like. but he's worried that it's going to lead to more people just taking on more debt and not having the responsibility for that debt. So he's worried about student debt continuing to go up because if there's a problem, the government will bail you out. He's also worried that it will just have people more confident that the government will bail them out from any debts going forward. And then the other issue that's still to be determined is whether the president can do this or not legally. Last year, Nancy Pelosi said that it had to be done through an act of Congress, not from a presidential authority. And then a couple of weeks ago, she said it could be done by the president. So that's still to be determined. But Jason Furman had a very negative view of this as well, that it was a breaking of a campaign promise, which is ironic because he's right. Part of the promise was that he would do student debt forgiveness, but the other promise was that it would be paid for, and it's not covered in this. So those are the issues for it. I think there's a lot of debate, pros and cons for doing this. I don't think the issue is doing for student loan forgiveness, although Nassim Taleb is not a fan of this either. But I think the issue is the way we went about doing it is more political than it is practical, and is not really the way most people would go about doing this. So I think there's a lot of issues to come with this, but it's just another sign of the fractured nature of the global economy, some of the underlying problems that exist, and really the challenges facing policymakers in bringing inflation down while getting growth back to a sustainable level so we can get back on track and deal with the problems that we're facing today. So I think from our perspective, it's going to be a really challenging environment. It's going to make for a very wavy and inconsistent movements in terms of bringing inflation down and getting growth back up. And we still have several big issues outstanding that will weigh on this and increase volatility as we go forward. So we think this is a good time to be very cautious about your investing, but take advantage of things that have pulled back considerably. We think there are growing opportunities to rebalance your portfolio to get some of the better fixed income yields that we haven't had in quite some time. But you really want to be careful about moving forward and avoiding high multiple stocks still as we go through. But we're in a very awkward environment for policymakers where they can't do as much as we'd like. There'll be a lot of lip service and a lot of short-termism to get through the election cycles, but inflation has to be brought down for us to be able to move forward. I think there are parts of it where it's coming down, but certain regions, particularly in Europe, they're going to be in for a tough time for an extended period. And I think that sets up for a more positive environment for U.S. investing. So, Mark, I'm going to stop there and open up to questions and comments.
We covered a lot of territory again. Questions, comments?
I put my comment in the chat. Excellent weekly update as usual. Thank you, Stephen.
Thanks, Michael.
Yeah, Stephen, I was really surprised at kind of the bluntness that Powell used on his announcement at Jackson Hole. That was almost like, pulling someone over, in the hallway and say, hey, let me tell you what I really think.
Yeah, it was really about bringing expectations back in line. And I mentioned that, I think, last Tuesday, that one of his big challenges is to get the street after the July announcement was too aggressive on rate cuts. And they were thinking that the Fed put was in, and he just told you it's not. And that was really the message from it. And it was really the street just being optimistic in a big rally to think that this is just going to continue because they wanted it to, I think. But if you looked at the bond market wasn't telling you what the equity market was, and he was bringing expectations back into line. And I think that's why he kept it as short. He wanted to hammer home the message that there's going to be pain. Unemployment's going to have to rise for us to get there. And it's going to stay at a higher level than they think. And it may go to a higher level in terms of getting to neutral faster than people think. And that's what the market reacted to, is the Fed puts off. And I think that goes back to the view that everything's changed for us. in the world. We're in a new regime, and that's what he was driving home the message on.
Right. And, I think too, on the unemployment side, we've got, it's such a very different situation now as it was in the 70s, because they're at, in terms of just number, we'll forget about, quality of jobs, but there's still, a big gap between jobs available, versus actually, people looking. So it seems to me as though that, for them to be able to get to like a level of unemployment that they really want is going to be very difficult, which if you're just going by the numbers, then, are these guys like going to continue, to tighten and to create further demand destruction on that? And I'll just throw one more thing in. So additional demand destruction as being the potential solution, but nobody's talking at all about easing the supply side, which I think is it definitely is contributing a lot to this inflation as well.
The August Carstens at the BIS, the Bank of International Settlements, spoke last week at Jackson Hole, and he highlighted what you just said, Bill, that central banks' ability to deal with supply issues is very limited. They can really only deal with demand destruction. It's the fiscal side that has to deal with the supply chains, and it's been a challenge. And it really goes back to the short-termism, because if you look at the problem of Europe, they're in a problem today that was a problem that started years ago and many decades ago, and they just haven't addressed it right. And it's the over-reliance on Russian oil for Russian energy. Those types of decisions don't seem that big when they're occurring, but get big a lot later on. And I think that's really one of the things that you're seeing there.
Other comments? Go ahead, Stephen.
Yeah.
Or Adrian's got his hand up. Go.
Go ahead, Andrew. Adrian?
Thanks, Mark. Two just very quick questions. The one is the student debt forgiveness just a very, very modest veiled version of a Greenspan put? I mean, to me, I interpret it as just a variant on printing of money. I'd love your thoughts on that. And when it comes to the inflation outlook, which becomes more and more robust, demand challenges to demand in the real economy pull the rug out from commodity prices, but inflation feeds commodity prices. Of those two forces, which one do you think holds the upper hand as things stand?
I'll start with the second question, then you'll have to give me the first question first again. But the inflation supply and demand issue, I think, on commodities, I think is more complicated than that. I think it's an issue of China managing their COVID issue after their party Congress, which I think is now set for mid-October. I think it starts on October 16th. Whether how fast they start reopening again, and do they shift from their zero COVID policy to vaccines and try and reopen the economy faster, because I think that's been one of the big suppressants on commodity prices as well, is China's lockdown, being that they're such a big commodity user as well as producer. But I think the outlook on inflation is very different for different areas too. I think the US is not in the same boat as Europe. I think Europe's, really over a barrel of oil and gas right now, and with no easy way out of it, where the US can deal with our inflationary issues a little bit better. So I think it puts Europe in a very difficult spot and pushes them into a recession at some point in time. I think the issue on a lot of what happens to the global economy will determine how China manages through their issues as well, and how fast can they deal with the pressures that they're under economically, because a robust China changes the dynamics for the global economy considerably, but I don't see them being as robust as they've been. So you're going to have to rely on a much slower growth environment for an extended period. On the student loan question that you were asking, is it the same as stimulus? in a sense it is, but there's more moral hazard with this than another stimulus program, in that you had a lot of people who paid their debts off, and why are they subsidizing the people who didn't, and why are we paying for people to go to graduate school or law school or something like that? Doesn't really make as much sense as where you're helping people who are really in need. So I think those are a lot of the issues that go on around that. Yes, it is a giveaway. It was a campaign promise. I think for certain people, it makes a huge difference. For others, I think it's not what we should be doing. So I think it is a very complicated situation that I got in trouble with 2 weeks ago from trying to simplify it. So I'll avoid that this time. But there's pros and cons to doing it. I think the timing of it is the bigger issue right now. This is the wrong time to be doing this type of stuff. There are other ways to deal with it. I think that's the issue. And I do think Summers being so strong on this is a sign that he doesn't think that it's a really good use of money given the overall problems. I think it's a big issue for those people that benefit from it, but for the overall economy, I don't think it's going to move the needle much. I think that's the real issue with it. We have real
Sorry.
pressing issues. Go ahead, Mark.
Michael Hammer, question?
Yeah, so first, is there ever a good time to do anything like this?
Yeah,
At least from
when
a
interest
political-
rates, when you bring interest rates down to zero at the start, right? And you have the ability to do, you're trying to stimulate, not 10 years into it. It would be a worse time. So
But we also have to recognize he's under a time constraint, right?
Yes.
Midterms are coming up fast, and 2024 we're closer to than 2020 from a presidential election perspective. But I just wanted to comment on energy. Yeah, Europe's in a tough spot. It's probably going to get worse. I've noticed that natural gas, which I follow closely, is down a bit in both the US and European markets. I think folks are not calling it correct. The high inventory in Europe, Germany meeting its goals early, I think is a head fake, if you will. But because I own a farm, I think food commodities, agricultural commodities will continue to be a source of inflation with drought in many regions of the world, and then floods. I think output and yields are going to be down. So that's going to be quite interesting over the next year or so.
And what you're highlighting is exactly what the central banks are worried about, is that runaway food and energy inflation. They need to kill demand in other areas so that they can help lower the overall bill. And I think that's really part of what they're trying to do, because they know they can't solve the energy or food problems quickly. So it puts us in a pretty tough spot. Policymakers in a really tough spot. And the politicization of everything is just a reality right now. So any policy that comes out will have some political undertones with it, given where we are in the midterms and then the presidential election coming up 2 years.
Other questions? Comments?
There was Mark, there was some debate from whether Powell's switching to the more higher frequency of communications has actually helped or hurt. As the July 1 presser that he had, probably wished he had a do-over on it. So I think that does the communication change from the central banks, and how do they manage that is going to be another interesting question that comes up. Because I think he's done an admirable job, but I think the fiscal stimulus that came in the last 2 years was too much for the system to take, and they didn't course correct with that, partly because they had a view of communicating their goals to the market better, and I'm not sure that worked out the way they had hoped. that aside from the transitory issue that has been haunting him and me for some time.
Fair enough. Anyone else with a question or a view to share? I have 8 more minutes.
Well, I was just going to propose a scenario, Stephen. Maybe you can play with this. I thought Powell's message was, we're going to 4%. And at some point, you can't keep going 75 basis points. And it's probably more important to make sure you do something in every meeting to keep cementing the message. And part of the global inflation in other countries is how strong the dollar's been. So these other central banks really need to catch up a little bit. And to me, that it was in Jackson Hole, where you've got representation from all over the world, it felt to me like there was, a coordination in a way of central banks saying, okay, we're all going to fight inflation like crazy here. Try to walk a tightrope a little bit. And, it's like, get rid of this notion that we're going to raise rates, then we're going to lower them. And so the question then becomes, if you use the P multiple risk-free rate on the bond or the 10-year note, let's say it's 4%, we were already at 3.5%. The market spent the better part of 6 months making that, the stock market that is, making that inflation adjustment. And, if we go from where we've been when we were worried about a nuclear war, worried about, all sorts of, crazy stuff just beyond the pricing of the market, maybe the market sort of gets used to this higher rate and the PE of the higher rate, and it doesn't have to go and have another complete blow up the way it did before. And isn't there a pretty good argument that during midterm years or after midterms that you end up with a better market? And as you say, maybe it's an adjustment of what parts of the market respond, but I'm almost wondering if we just had the worst of it Friday already. And, we might meander along here a little bit and just get real about, what multiple we want to trade at. And it's not that far from where we already were. We were at 3.5 already. Now we go back there, maybe go up another quarter.
I think, Duncan, we've gone through we've lived through periods where the markets have done quite well with 4% Fed funds rates. Right? So that's not really the issue. The issue is the process of going from 0 to 4, from 1 to 4%, and how fast that happens is what requires the adjustment. Once you're there, things start to adjust on their own, and the market gets their expectations in line. I think what Powell was doing was what you said. He was taking away the Fed put and setting people up for an extended period of higher rates than they've gotten used to over the last 10 years or even 20 years. And I think that's really what he's really driving at. And it's to reset the expectations so that the market moves towards a little bit more fundamental basis and a lot less Fed put in it. And I think that is what they were trying to do. I also think the other message that was a coordinated message for the central banks is there's going to be pain felt all around the world as you deal with inflation. There always is, and you're just going to have to suck it up. And I think that is part of the issue. I think your point on the dollar is going to be a persistent problem for the rest of the world until we stop raising rates and they keep raising them, or our economy weakens to a degree that is significantly worse than theirs, which I don't think many people see coming soon. So I think that's going to set us up for where you have to make some serious adjustments to your policy. And it goes back to our view after the war started, that's when we said everything's changed. And I think that's what Powell's starting to reflect now, is that things really have changed now for the foreseeable future. And it's not going to be the every time we have a little bit of a setback, the central banks will step in or the government will step in and bail the economy out. I just don't think they have the wherewithal to do that anymore. Now,
all right.
the
I
other
was- I-
point, though, Duncan, I would say, and this is Mark, I just want to jump one last thing. Ed Yardeni, who, we follow closely, believes that June 16th may have been the low for the equity market. Now, not that you might not test it again, but you're in a period where you could get back there. But he thinks the low's in and that you have, we'll get to new highs in 23 in the market. So in the US, to give you a sense.
Just one second, Bill. I know, Bill, you're helpful on so many fronts to this discussion. But I think just a reminder on this event is going to be a really great global, let's say, interconnecting on all these, a lot of the issues that we've been talking about, macro. So I'm excited as we lead up to that to bring a lot of viewpoints. Sorry, Bill, you hand raised?
Yeah, just sort of further and maybe even more to your point, Mark. Stephen, what you suggested, it really sets up a very interesting situation where if we have a significant differential between US inflation and non-US inflation, particularly in Europe, I think that probably even makes the case even more for, more of a focus investment wise on the US, but also, sort of importing inflation, from Europe in terms of like how much of that might happen. I don't have the numbers in front of me, but obviously, they're a big trading partner. But even still, but it's such a unique, focused, and localized situation over there, primarily because of the energy situation. I mean, if they didn't have that, it'd probably be like so much better. But again, I just see this huge, potential huge differential between US and non-US inflation.
Yeah, but then the stronger the dollar gets, the more we import deflation rather than inflation. So it's going to create inflationary pressures even further over there and lower our inflation pressures, which then actually attracts more capital here, as long as their yield differential doesn't get too great. So it's going to be it's a setting up for a fascinating time. And I think the challenge is for us as investors is we have to rethink valuations to move from zero interest rates to a 4% rate environment and start to think about it in that context, which then changes your math on a whole bunch of things that you're doing in your portfolios now. I think that's really one of the big issues that we have to go through. That's the next big adjustment that's going to come, I think, is how do you think about your return expectations and your risk reward on portfolios in that environment that you just described.
So Stephen, where does that put, like, just say Google and Amazon, two great companies, right? Are they priced right? If you have a 4%, let's just say the risk-free rate's 4% for the next 10 years. Are Google and Amazon at the right price earnings ratio? And I don't mean to pick maybe Microsoft, think of the great benchmark equities. Are we still mispriced on those? And it's just the
Possibly depends on if they can sustain their growth rates or not. That's really the issue for these stocks is can their growth rates continue the way they had been, or not even at the same rate, but at above average rate that they've continued to grow into their valuations. The question is, can they continue to do that? I suspect, well, we recently added to Amazon, so we would say that we believe that's undervalued. Google's a little bit tougher because a big part of their business is under a lot of pressure right now with advertising and regulation. So I'm not as certain on that one right now, although I think it's probably pretty fairly valued. It just depends on can they sustain their growth rates. And in both cases, they're not big China players, so that's not a big issue for them. So I don't really see that as really but I do think when you look at some of the big winners from last year, like the Teladocs and the Trade Desk and the, Chegg and companies like that, the work from home kind of winners, I think that's where the multiples are really a challenge, because they were on stilts. And I think you have to be really careful with that one.
Yeah.
But I'll be
Walter-
wrong in a couple of years on this anyway, so.
Walter has a question And I'm just gonna ask that, carry on, I'm gonna be on another parallel Zoom here.
Yeah, and I'll be quick. And once again, Stephen, thank you very much. This was very interesting. I have a selfish question. Our company has cross-border investments, but mostly with Latin America. And today we're seeing how Latin America in general, Brazil and Argentina, and even Chile, they've been exporting quite a bit of food
Mhm.
because of what's going on over in Europe. The strengthening of the dollar makes their income higher. What kind of inflationary pressures do you see happening in Latin America?
Well, they're experiencing some pretty tough inflation in a lot of the nations down there.
Mhm.
So I think they're going to be under pressure. It depends on if you're a commodity producer, an exporter, or an importer. I think is really going to be the big determinant for a lot of those countries right now. And then the other element is you're going through some pretty significant policy changes as you have government change going there. And Brazil is going to be a very fascinating case of how that election plays out. You're already in a mode where the elections before the election happened has been called fraudulent.
Right.
And Lulu could be coming back. Looks like he's going to come back in. So what policy changes go in place and what do those policies mean to their, the inflationary pressures that those countries are going through, I think is going to be, and do they help growth or hurt growth in the near term with the policy changes? I think all those things come into play here. So I think the Latin American nations, if you're not a big commodity producer, are going to be struggling.
Mhm.
Hey, Bill, can you?
Yeah, sorry.
Steve, can you
Yes,
hear
I'm trying
me?
to hear you, Rob.
Yeah, just a quick question on this, I guess, the disclosed number, I think I recall was like 1.1 billion of US arms sales to Taiwan. Does that surprise you at all that that was sort of out and as transparent? It would seem like Capitol Hill would take a little bit more of a muted approach.
There's, the policy over on how we're handling Taiwan is way above my pay grade. I think, but when it comes to the support we're giving them, I think the administration or the Defense Department felt it was probably a good message to send right after the last couple of weeks. But I really don't have any particular insights on that, Rob, other than we have been pretty open about what aid we're sending to Ukraine too. And I think every time we send $1 billion of armament over there, they highlight the number. So I'm not sure it's all that different. I think we are trying to send a message that we are still supporting Taiwan to China. So I think that's what they're trying to do with that.
Okay, thank you. By the way, your pay grade's pretty high, so that's a tough hurdle.
Well, we're a small company, Rob. Other questions or comments or thoughts? Mark took off to another call, as he's known to do.
Sure,
And
I'll jump.
Anessa, you put everything into the chat box for people on hotels and stuff for the meeting. So if you need anything,
Multiple times, it should be in
Yeah.
there. And in
Yeah.
case anybody hasn't seen it in the chat, you can see it in the link for the deck, which is the place where we capture all of our information about suggestions for the agenda and provide all travel information.
and the hotel for the Mayfair is booked, today's the last day, I believe. Is that what the chat said, Jim? And then for the others,
Today is the last day, although we think, it's a little past close of business for the US, depending on your time zone. Probably you have until close to midnight London time.
that's, Michael, you had a question? See a hand up? Michael?
Yeah, so some of your comments got me to thinking, it'll be interesting for the multinationals, the impact of Forex on them. So you've basically been talking about countries, but I tend to look more at the micro company / investment opportunity level.
Mhm.
And so I'm just wondering if you have any comments on which multinationals might be winners or losers based on Forex impact and their ability to redeploy income streams locally as opposed to repatriating?
Well, the chip industry is probably the best example of redeploying locally of any out there, right? That's underway and big in your neighborhood with Intel and now Brookfield partnering to build the plant in Ohio. I think there's a number of the big tech multinationals that the dollar conversion will hurt, although the dollar's been strong all year and it's gotten a little more strength lately, but I don't think the dollar's in a continued up move right now. So I think this quarter is more flattish. I think a lot of the pain was felt last quarter for a lot of the multinationals. I think they're also going to be focused. The other issue, Mike, you have to focus with the multinationals isn't just the dollar, but which one of those weren't paying the global minimum tax and who's going to get hurt by that as well. So I think that's another factor you have to come in. I would say the biggest companies that are out there are going to be multinationals going to be faced with two issues: a slowing China and a stronger dollar, and you have to factor that into your valuation. I don't have the specific names to give you that. I'd have to get one of my partners on who could give you the names better. But I know one that's going to get hit pretty hard would be, and not harder than anybody else, but pretty hard, is IBM, who had a low tax rate and a lot of foreign dollars, a lot of foreign revenues. But companies like that, I think some of the consumer companies are also going to get hurt by it as well. Jim, I don't know if we have any more questions.
I think that could be a wrap. I would just close by saying, please, if you have not, go to the website that Inessa has put into the chat. Inessa, if you can make sure you drop it one more time into the chat if you're monitoring here, so that everybody has our probably best resource to get information on the upcoming London and Europe tour. And I think that's probably it. Thank you, everybody, for being with us.